following podcast was recorded on Friday, March 31st, 2023, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Good morning, Kristen.
We're looking forward to hearing your talk this morning, talking about the other parts of SVB. After the events of the last few weeks in banking, there's angst over bank exposures to specific sectors of the economy. It's a two-sided equation, Sam. You've got lending and deposits. Silicon Valley Bank had concentrated exposure to VCs for both lending and deposits. Is there another area of concern that hasn't been discussed?
Well, this is the really interesting part that, it gets talked about, but I don't think it gets talked about enough, is that VC was really supposed to be one of those interesting, fairly non-volatile areas. We can kind of laugh about that, but they were lending, typically against securities that didn't move that much, that were backed by very, very large and pretty, well-known investors. So these weren't really supposed to be that risky, right? Those deposits were supposed to be fairly sticky. They weren't supposed to move around. And what we found out earlier this week was that they were going to move $100 billion in deposits in a single day. I mean, the power of being able to move money on a phone is pretty spectacular. But I do think that it's worth kind of taking a step back and realizing that over the last 40 years, this isn't the first time we've seen a significant exposure to a limited depositor base and a fairly concentrated lending book end up being highly problematic for very specific regions and very specific types of banks. So I don't necessarily think that we're going to see more of this. We may be on the other side, but it's worth taking a step back and really beginning to think about what else could be out there and what else could begin to look a little bit like the VC run.
Well, let's talk a little bit about oil and gas exposure. In the past, that lending has had its own significant problems. Oil and gas has had booms, it's had busts. What's the big exposure, right? Who has the biggest exposure right now for oil and gas?
It's probably JP Morgan. It's pretty hard to parse out some of the data points on the exact exposure. And part of that is, that the size of the bank really matters, right? JP Morgan is massive. So it's probably, it's going to have the largest exposure on a gross basis. The interesting point here is that you really haven't seen banks dive into oil and gas lending, even in a way that, you would have thought with $80 to $100 oil, you just haven't seen it. And, it's probably, I would say, almost a positive for the stability of the overall banking system that ESG really got in there and said, please stop lending, please stop lending. And there really was a little bit of a retrenchment away from the oil and gas industry. Taking a step back, I really like to think about the example of the 1980s that seems like it was forgotten here, right? That, in the blow up of SVB, California is rather concentrated in tech and, startup tech, et cetera. But you really only had a couple of banks go down. You didn't have the entire banking industry collapse, which I actually think is pretty good thing and pretty spectacular. Honestly, particularly with the pain that you've seen in the VC world. In the 1980s, particularly the late 80s in Texas, you had 9 of the 10 largest banks fail. I mean, think about that for a minute. And you don't really hear a whole lot about it, but it was a very bad time to be in banking in Texas, right? Oil collapsed in terms of its price coming out of the 70s, and banks didn't really pay that much attention. Neither did oil companies, right? They kept hiring and they kept pumping oil out of the ground, and it eventually came back to haunt everyone. So this volatile, call it end market, right, really ended up affecting not just the oil and gas economy. It really affected the overall economy, whether it was healthcare in Texas, whether it was real estate. Everything took a huge hit. And I think that's one of the lessons that we can kind of actually feel pretty good about with SVB, is that we haven't really seen the VC slaughter really go to the rest of the economy. You haven't seen other bank failures. You haven't seen a significant pullback in lending to consumers. Credit card availability is still out there. Maybe it's a little bit harder to get a home, but at the same time, you did also see pending home sales begin to pick up a little bit. So there's a number of minor positives here that I think may be a little bit too overlooked. And one of them being that even with what we've seen out of SVB, you haven't seen the Texas-style Oilmen massacre that could have happened.
How do tightening cycles impact oil and gas lending?
It's interesting because typically when you have a tightening cycle, that's indicative of two things. One, then the economy is doing pretty well, and two, that you have accelerating inflation, or inflation is at least somewhat problematic. That tends to be good for oil and gas, and oil and gas lending actually tends to pick up a little bit and be good for banks in that environment, because they can go to oil companies, lend them money at higher interest rates, and oil companies can typically drill and put those back. So in the end, it's one of those where oil and gas lending is actually typically not a bad place to be during a tightening cycle. It's a very bad place to be during a down rate cycle. Down rate cycles tend to be very bad for oil because guess what? That's typically a sign that the economy is not doing well, global economy is not doing well, and oil tends to fall and can fall rather precipitously. So it's a double-edged sword on that front. But in general, the interesting part here is that oil and gas lending doesn't seem to really be a problem at all for banks, and it doesn't seem to be a business that they've really engaged much in. Part of that being that oil companies have just recycled a lot of their cash back into shareholder returns and not drilling incremental wells, and they can self-fund their CapEx. So they're really not demanding that incremental loan or that incremental dollar from anybody at this point. So overall, it's an interesting cycle for banking, and I think we're going to continue to see a few shoes fall. On the commercial real estate front, that's one that people continuously talk about as being the next shoe. A lot of that isn't on bank balance sheets. There's regional exposure on the regional banks is somewhat significant, but a lot of that is off balance sheet with non-bank entities. So we may actually see less of a quote unquote banking issue and much more of a non-bank issue as we begin to reach some pretty high interest rate levels here.
And Sam, what are the longer term implications going to be for VCs?
I think it's going to be a lot like oil, and this probably isn't a popular take, but I think it's going to be a lot like oil. It's going to be viewed as a much more risky area to lend into and much more risky area to bank. And it's going to be very, very similar to the banks that said, I'm not really sure I want to bank a whole lot of oil and gas. That when that becomes volatile, it can really, well, one, it'll hit my deposits, but it'll really crank down on my lending book. I'm going to be much more careful. I'm going to charge a lot more interest. And if I do bank them, it's going to be very expensive to do so. So I think you're going to see not necessarily a debanking of venture capital, but you're going to begin to see much, much finer pencil being put to paper on how banks underwrite the risks.
In summary today, Sam, what should we be watching for next?
I think instead of commercial real estate and that side of things, I would be really closely watching how banks begin to interact with venture capital and venture-backed firms in particular. I think that's going to be a really interesting story as we move forward for the next 3 to 5 years. A lot of these venture firms, they're in funds that are, their lives are 8 to 10 years in length. So you're going to continue to see some pressure. You're going to continue to hear about funds probably having to broaden out their banks that they use with their portfolio companies. And you're probably going to hear some, call it angst, around how expensive the banking has become and how difficult it's become to get founders the banking that they're used to.
Sam, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great day.